Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for educational and entertainment purposes only. The information shared here should not be taken as financial advice. Investing involves risk, including the potential loss of principal. Always do your own research and consult with a qualified professional before making any investment decisions. What if I told you that a single $10,000 investment in 1977, placed in the hands of one man running one mutual fund, would be worth more than $28 million by 1990? That's not a typo, not a lottery ticket, not some flash-in-the-pan crypto coin. A $28 million fortune from 10 grand in just 13 years. During that same period, the same $10,000 in a standard S&P 500 index fund would have grown to about $64,000. A respectable return for sure. But it's not life-changing. It's not generational wealth. It's not even in the same universe. So what was the difference? What was the secret sauce in that one fund, the Fidelity Magellan Fund, that allowed it to generate an average annual return of over 29% for more than a decade? Was it luck? A fluke? A once-in-a-lifetime anomaly that we'll never see again? The answer is no. And understanding that answer is the key to unlocking a level of financial growth that most people believe is impossible. You've probably felt it. You open your 401k statement, you look at your IRA, and the numbers just plod along. They go up a bit in a good year, down a bit in a bad one. Feels slow, safe, and frankly a little boring. You're told to just buy the index, set it and forget it. You're told that trying to beat the market is a fool's game. And for many, that advice is perfectly fine. It's a ticket to an average retirement. But what if you don't want to be average? What if you're willing to do the homework to understand what separates the good from the truly great? That's exactly why we're here. Over the next 10 parts, we are going to embark on a deep dive. We are going to pull back the curtain and dissect the anatomy of the world's most successful, high-return mutual funds. This isn't about get-rich-quick schemes or risky day trading. This is about education. It's about understanding the repeatable patterns, the core principles, and the fundamental factors that power the engines of wealth creation. We're going to give you the framework, the mental models to analyze a fund not just by its past performance, but by the quality of its DNA. We'll explore the difference between a gunslinging fund manager and a disciplined value investor. We'll uncover why a fund's expense ratio can be a silent killer of your returns, and why another fund's high fees might actually be a bargain. We'll talk about turnover ratios, asset allocation, investment philosophy, and how to read a prospectus to find the red flags and the green lights that most amateur investors completely miss. By the end of this series, you won't just be looking at ticker symbols and star ratings. You'll be looking for greatness. You'll have the confidence to ask the right questions and the knowledge to understand the answers. So where do we start? With all the complexity of the market, what is the single most important factor that separated that legendary Magellan Fund from a simple index fund? It's not a what, it's a who. The first, and arguably the most critical factor behind any high-return active mutual fund is the fund manager. Think of a mutual fund like a world-class sports team or a symphony orchestra. You can have the best players or the most talented musicians in the world, but without a brilliant coach or a visionary conductor, all you have is chaos. The fund manager is the conductor. They are the coach. They are the single human element in a world of algorithms and charts who makes the final call. Buy, sell, or hold. Their philosophy, their discipline, their courage, and their vision are imprinted on every single decision the fund makes. An index fund has no conductor. It's a machine programmed to blindly buy all the stocks in an index, the good, the bad, and the ugly. It's designed for mediocrity by its very nature. An actively managed fund, on the other hand, lives or dies by the skill of its manager. The man behind Magellan's historic run was Peter Lynch. And Lynch wasn't a Wall Street wizard who spent his days staring at complex financial models. His philosophy was radically simple, and it's something you can use in your own life. He called it investing in what you know. He famously said, "Go for a business that any idiot can run, because sooner or later, any idiot probably is going to run it." He didn't look for complicated tech or obscure biotech firms. He found his best ideas at the shopping mall and in the supermarket. He noticed his wife loved a brand of pantyhose she bought at the grocery store called Legs. They were a massive hit. He did some research and found the parent company, Hanes. He invested and the stock went up sixfold. He was on vacation and was impressed by the service and quality of a hotel chain. It was La Quinta. He invested. He saw a long line of people waiting to eat at a new fast food joint called Taco Bell. He investigated the company, loved their business model, invested, and it became one of his biggest winners. This wasn't just about picking familiar brands. It was about using your real-world experience as a consumer to identify dominant, easy-to-understand businesses, and then doing the rigorous financial homework to confirm they were great investments. He wasn't trying to predict the future of the economy. He wasn't making big bets on interest rates. He was finding excellent companies one by one that were growing right under everyone's noses. He bought Dunkin' Donuts because he loved the coffee. He bought Volvo because he was impressed by their safety and reliability. He turned Main Street observations into Wall Street home runs. The result? That staggering 29% average annual return. He took a tiny, obscure fund with $20 million in assets and turned it into a $14 billion behemoth, the largest in the world at the time. He beat the S&P 500 index in 11 out of the 13 years he ran the fund. This wasn't luck. It was the result of a clear, consistent, and brilliantly executed philosophy, driven by one person. So, the first lesson, the foundational pillar in understanding high-return funds, is this: you are not investing in a fund, you are investing in a manager. You are betting on their brain, their strategy, and their discipline. A great manager with a proven process can navigate turbulent markets, sidestep disasters, and uncover hidden gems that an index would never find. A mediocre manager, on the other hand, will simply charge you high fees for average, or even below average performance. In that case, you might as well just buy the index fund. Finding a manager like Peter Lynch is rare, but they are out there. And the first step is knowing what to look for. You need to look past the short-term numbers and understand their long-term track record. How did they perform during the 2008 financial crisis? How did they handle the dot-com bust? Did they stick to their principles when the market was panicking? Or did they chase trends? You need to read their shareholder letters, listen to their interviews. Do they have a clear, understandable investment philosophy that makes sense to you? Or do they speak in confusing jargon designed to make them sound smart? A great manager can explain their strategy in a way that anyone can understand. Peter Lynch did. Warren Buffett does. The manager is the starting point. They are the heart of the fund. But they are just one piece of a much larger puzzle. A brilliant manager is necessary, but not sufficient. They also need the right strategy, the right structure, and the right philosophy to execute their vision. And it's that philosophy, the fundamental belief system that guides every single one of their decisions, that we will dissect next. That is the second critical factor, and it's where we'll go in the very next part. Imagine two generals on a battlefield. Both have the same goal, to win the war. They have access to the same types of soldiers, the same intelligence reports, the same terrain. But how they fight could not be more different. One general is a master of attrition. He believes in overwhelming force, in grinding down the enemy with superior numbers and relentless pressure. He builds fortified lines, amasses supplies, and wages a slow, methodical war of inches. The other general is a disciple of maneuver warfare. She believes in speed, surprise, and striking at the enemy's weakest points. She uses fast-moving units to bypass strongholds, disrupt supply lines, and create chaos behind enemy lines. Neither philosophy is inherently right or wrong, but the philosophy a general chooses will determine every single decision they make, where they deploy troops when they attack, and what kind of risks they are willing to take. An investment philosophy is a fund manager's doctrine of war. It's their fundamental, deeply held belief about how the market works and, more importantly, how to win in it. It's not just a preference. It's the entire operating system, the DNA of the fund. It dictates what they buy, when they buy it, and when they sell. And if you don't understand the manager's philosophy, you'll never understand why your fund is performing the way it is. The two most powerful and often opposing philosophies in the investment world are value and growth. They are the attrition and maneuver warfare of the financial battlefield. Let's start with value. The high priest of value investing is, of course, Warren Buffett, who learned at the feet of his mentor Benjamin Graham. The core philosophy of a value investor is deceptively simple. Buy a dollar for 50 cents. They are the ultimate bargain hunters of the stock market. They believe the market is often irrational, driven by fear and greed, and that this emotional roller coaster causes the stocks of perfectly good companies to be sold at prices far below their true, intrinsic worth. A value manager isn't looking for the next hot thing. They're looking for the current great thing that everyone else has overlooked or unfairly punished. They are financial detectives, poring over balance sheets and income statements. They're looking for clues. They want companies with low price-to-earnings ratios, meaning they're cheap relative to their profits. They want strong balance sheets with little debt, creating a margin of safety. They look for durable competitive advantages, a moat, as Buffett calls it, that protects the business from competitors. Think of Coca-Cola's brand name or a railroad's exclusive tracks. These are businesses that are built to last. A value manager's favorite time to shop is during a panic. When the market is selling off indiscriminately, they are the ones running into the burning building, calmly sifting through the rubble for discarded treasures. They believe that over time the market will come to its senses and recognize the true worth of these companies, and the stock price will rise to meet its intrinsic value. It's a patient, disciplined approach that requires a strong stomach and an almost stubborn refusal to follow the crowd. On the other side of the battlefield is the growth investor. If the value investor is a historian, the growth investor is a futurist. They aren't concerned with what a company is worth today. They are obsessed with what it could be worth tomorrow. Their philosophy is that the greatest returns don't come from buying cheap assets, but from investing in companies that are poised to dominate the future. They are looking for the next Amazon, the next Google, the next Tesla. A growth manager is less concerned with a low PE ratio. In fact, they're often willing to pay a very high price for a stock if they believe its potential for future growth justifies it. They are looking for different clues. They search for companies with rapidly accelerating revenues, expanding market share, and disruptive technologies or business models that are changing the world. They ask questions like, is this company stealing customers from the old guard? Is its product or service becoming essential? Can it scale its business exponentially? They are investing in vision and potential. They believe that a handful of truly innovative companies will generate the vast majority of the market's long-term returns. And the key to winning is to identify and hold on to these future giants, even if it means paying what looks like an expensive price today. This philosophy often leads them to technology, healthcare, and other innovative sectors where change is constant and the winner can take all. Now, it's rarely a perfect dichotomy. Many of the most successful managers in history have blended these two philosophies. This leads us to a third, incredibly powerful approach: growth at a reasonable price, or GARP. The legendary manager of the Fidelity Magellan Fund, Peter Lynch, was a master of GARP. A GARP investor is trying to get the best of both worlds. They look for the explosive potential of a growth company, but have the discipline of a value investor who refuses to overpay. They're looking for a company that might be growing at 25% a year, but they're only willing to buy it if the stock is trading at a PE ratio of, say, 20. They want the speed of the race car, but they're only willing to buy it at a used car price. This hybrid approach seeks to avoid the so-called value traps, cheap stocks that are cheap for a reason and never recover, and also avoid the growth traps, high-flying stocks with sky-high expectations that come crashing back to earth when their growth inevitably slows. Beyond these big three, other philosophies guide different funds. There's the contrarian. This manager makes a career out of zigging when the entire world is zagging. Their core belief is that the consensus is almost always wrong. They actively seek out hated, despised assets in industries that everyone else has given up on. Their defining moment is buying when there is, as the old saying goes, blood in the streets. Then there's the momentum investor. This philosophy is the polar opposite of the contrarian. They believe that trends persist. Their motto is, the trend is your friend. They buy stocks that are already going up and sell stocks that are going down. They aren't trying to predict the future. They're trying to ride the wave of the present, believing that a stock in motion will stay in motion. Finally, there's the income or dividend-focused philosophy. These managers are like landlords. Their primary goal isn't necessarily dramatic price appreciation. It's to buy companies that act like cash machines, stable, mature businesses that consistently pay out a portion of their profits to shareholders in the form of dividends. They believe in the power of compounding those regular cash payments over time to generate a steady, reliable return. So why does all this matter to you? Because the manager's philosophy is the single biggest predictor of a fund's behavior. A value fund is likely to hold up better during a market crash, but may lag during a roaring, tech-fueled bull market. A growth fund might shoot the lights out when optimism is high but can suffer breathtaking losses when sentiment turns sour. A GARP fund might not capture the absolute highs or lows, but it might provide a smoother ride over the long term. The philosophy tells you what kind of companies you will own, what kind of risks you are taking, and in what kind of economic environment your investment is most likely to thrive. When you look at a mutual fund, you need to look past the name and the recent performance. You must dig into the fund's prospectus, read the manager's quarterly letters to shareholders, and watch their interviews. You're listening for the keywords. Do they constantly talk about margin of safety, intrinsic value, and undervalued assets? You've found a value investor. Do they obsess over total addressable market, disruptive innovation, and revenue acceleration? That's a growth investor. Understanding this philosophy is like being handed the playbook before the game starts. It allows you to align your own expectations with the fund's objective. You won't panic and sell a value fund just because it's underperforming the S&P 500 during a tech bubble, because you understand that's not the game it's designed to play. You'll know its time will come. A philosophy, however, is just a belief. It's the why. But a belief without a concrete plan of action is just a wish. The real magic happens when a manager translates that core philosophy into a rigorous, repeatable process for finding, analyzing, and selecting investments. That process, that step-by-step plan for turning belief into profit, is the fund strategy. And that is the third critical factor we must understand. If a fund's philosophy is its constitution, the set of unbreakable beliefs, then its strategy is the detailed book of laws. It's the operational manual. It's the recipe. Think of it this way. Two chefs can share the same philosophy of farm-to-table fresh ingredients. But one chef's strategy might be to create complex, 10-course tasting menus, while the other strategy is to perfect the simple, classic hamburger. The philosophy is the same, but the process, the strategy, leads to wildly different outcomes. And it's in the nitty-gritty details of that process where fortunes are made or lost. A fund strategy begins with a single foundational question. Where do we hunt? This is called the investment universe. It's the defined pond where the fund manager is allowed to fish. For some funds, this pond is massive. A global large-cap fund might have a universe of thousands of the biggest companies across the entire planet. For others, it's a tiny specialized puddle. A U.S. microcap biotechnology fund might only look at a few hundred very specific American companies. Why does this matter so much? Because the universe defines the fund's potential and its risks. A manager with a broad, global universe has an enormous number of potential opportunities. If the U.S. market is overpriced, they can hunt for bargains in Europe or Asia. But the downside is that it's nearly impossible to be a true expert on everything everywhere. They risk becoming a jack of all trades and a master of none. Conversely, the manager of that tiny biotech fund can know their specific universe inside and out. They can know every company, every drug trial, every CEO. Their expertise can become a massive competitive advantage. But they are completely at the mercy of their small pond. If a new regulation crushes the entire biotech sector, or if investors simply lose interest in it, their fund is going down no matter how skilled they are. Understanding the fund's stated universe is your first clue to understanding its strategy. It tells you the boundaries of the game they've chosen to play. Once the hunting ground is defined, the real work begins. How does a manager go from a universe of, say, 3,000 US stocks down to a portfolio of just 50? This is the screening process, and it's a multi-stage filter designed to systematically weed out the bad, the mediocre, and the simply uninteresting. The first filter is almost always quantitative. It's a computer-driven process that sifts through the entire universe looking for stocks that meet certain numerical criteria. A deep value fund, for example, might run a screen for companies with a price-to-earnings ratio below 15, a debt-to-equity ratio under 0.5, and a consistent history of paying dividends. Poof! In an instant, the universe of 3,000 stocks might shrink to just 300. A growth-focused fund would run a completely different screen. They might look for companies with revenue growth over 20% per year for the last 3 years and high gross margins, regardless of their current PE ratio. Their list of 300 names would look nothing like the value fund's list. This initial screen is just the first cut. It gets rid of the obvious non-starters. But now the human element, the real art of management, takes over. The manager and their team of analysts take that list of 300 companies and begin the long, arduous process of qualitative analysis. They start reading. They read annual reports, quarterly filings, industry publications, and competitor analyses. They're no longer just looking at numbers, they're looking for a story. They're looking for what Warren Buffett calls a durable competitive moat. What gives this company an edge that's difficult for a competitor to overcome? Is it a powerful brand like Apple or Coca-Cola? Is it a network effect where the service becomes more valuable as more people use it, like Facebook or Visa? Is it a patent on a life-saving drug? Or is it a low-cost advantage like Walmart or Costco that allows them to consistently undercut the competition? This qualitative screening is about identifying the true long-term quality of a business. A company might look cheap on paper, but if its business is slowly dying, it's not a bargain, it's a trap. Through this intense research, the list of 300 might get whittled down to 100. Now comes the most critical step in the entire strategy valuation. The manager has identified a list of high-quality companies that fit their philosophy. But the single most important question remains: what is it worth? Finding a great company is only half the battle. The real secret to high returns is buying a great company at a fair or even a cheap price. Every sophisticated fund has a rigorous and repeatable valuation methodology. They don't just feel that a stock is cheap, they build a case. For many, the gold standard is a discounted cash flow, or DCF, analysis. This sounds complicated, but the concept is simple. They try to project all the cash a company is going to generate in the future, and then they discount that future cash back to what it would be worth in today's dollars. It's an attempt to calculate the intrinsic value of a business, completely separate from its fluctuating stock price in the market. If their DCF model says a company is worth $100 per share, and it's currently trading at $60, they found a potential investment. Other funds might use a relative valuation approach. They'll compare a company's valuation metrics, like its PE ratio, to its direct competitors or to its own historical average. If a company has historically traded at 20 times earnings and is now trading at 12 times earnings, despite its business being stronger than ever, that could signal a buying opportunity. The specific method isn't as important as the fact that a disciplined method exists at all. The manager isn't just throwing darts. They have a clear logical reason for why they believe a stock is worth more than what they are paying for it. This valuation process is the final, finest filter. The list of 100 potential companies might now become a buy list of just 20 or 30 names that are both high quality and attractively priced. But the strategy isn't finished. Now the manager has to actually build the portfolio. This is portfolio construction, and it's all about managing risk. How much of the fund's money should go into each stock? This is called position sizing. Some managers run highly concentrated portfolios. They might put 5%, 8%, or even 10% of the entire fund into their single best idea. Their belief is that your best ideas should have a meaningful impact on your returns. If you find a once-in-a-decade opportunity, you shouldn't just buy a tiny amount. These funds offer the potential for spectacular returns, but also carry higher risk. If one of their big bets goes wrong, it can seriously hurt the fund's performance. Other managers prefer more diversification. They might cap every single position at just 2% or 3% of the portfolio. They own more stocks, and their performance is driven by the success of the group as a whole, rather than any single company. This approach smooths out the ride. It lowers volatility and protects the downside, but it also makes it harder to generate truly explosive returns. Neither approach is inherently right or wrong, but the fund strategy document, the prospectus, will tell you which game they're playing. Finally, a robust strategy includes clear rules for selling. This is often the hardest part of investing. A good manager defines their sell discipline in advance, before emotions get involved. They might have a rule to automatically sell a stock if it hits their calculated intrinsic value. Or they might sell if the original reason they bought it, the investment thesis, is proven wrong. Maybe a new competitor emerges, or a new technology disrupts the industry. Having a clear sell discipline prevents managers from falling in love with their stocks and holding on too long, or from panicking and selling a good company during a temporary market dip. This entire process, defining the universe, screening for quality, calculating value, constructing the portfolio, and defining the sell discipline, this is the strategy. It's a systematic, repeatable machine for converting a philosophical belief into a real-world portfolio. It's the bridge between a good idea and actual profit. But even the most brilliant strategy, the most detailed recipe in the world, is worthless if the chef doesn't know how to cook. A plan is just a piece of paper until it is executed, day in and day out, through market panics and manias, with unwavering discipline. And that execution, that real-world performance, is what creates the track record. The evidence. And that is the fourth critical factor we need to dissect. So, what is a track record? On the surface, it's just a series of numbers on a page. A chart that goes up, down, or sideways. Most people look at it for about 5 seconds. They see a line going up steeply and think, that's the one. And that, right there, is one of the most expensive mistakes an investor can make. Because a track record isn't just a chart. It's a story. It's the fund manager's battle-scarred diary, written in the ink of real-world gains and losses. It's the pilot's logbook, detailing every flight through clear skies and terrifying turbulence. And learning to read that story to understand that logbook is the difference between blindly gambling on the past and intelligently investing in the future. The fundamental error most people make is called performance chasing. It's the simple, seductive idea that last year's winner will be next year's winner. It's like driving a car by looking only in the rearview mirror. It tells you where you've been with perfect clarity, but it tells you absolutely nothing about the sharp turn or the stalled truck just ahead. Financial companies know this is how people think. That's why their advertisements always scream about their #1 ranking last year, or 50% returns in the past 12 months. They are baiting the hook with our most basic human instincts, greed and the fear of missing out. But a true student of high-return funds knows that the past is not a prediction. It is evidence. And you have to be a detective, not a speculator, to properly analyze that evidence. So how do we do it? How do we read this diary? The first thing we look for isn't the sheer height of the returns but the consistency. Imagine two funds. Fund A, the hare, had an incredible year, returning 50%. The next year the market turned and it lost 30%. Fund B, the tortoise, returned a steady 12% in the first year, and another 12% in the second. After 2 years, who's ahead? Your initial $100 in Fund A grew to $150, then fell to $105. Your $100 in Fund B grew to $112, then to $125.5. The slow and steady tortoise didn't just win, it crushed the hare, and with a lot less heartburn along the way. High-octane returns are exciting, but they often come with gut-wrenching volatility. What we're looking for is a track record that demonstrates an ability to compound wealth steadily over time, not a lottery ticket that hit big once. Consistency is the hallmark of a repeatable process. The second and perhaps most critical step is to interrogate the track record during times of crisis. Don't just look at the good years, zoom in on the bad ones. Pull up a chart of the fund's performance and overlay it with the S&P 500. Now find the scary moments. Find the fourth quarter of 2018. Find the COVID crash of March 2020. Find the brutal bear market of 2022. This is where the manager's diary gets interesting. This is where you find out if their philosophy of buying quality companies or protecting on the downside was just marketing fluff, or if it was a deeply held conviction they actually executed on when the world was on fire. Did the fund fall less than the overall market? This is called downside capture, and it's a huge indicator of a manager's risk management skill. It's easy to look like a genius in a bull market when everything is going up. A rising tide lifts all boats, even the leaky ones. But when the tide goes out, you see who's been swimming naked. A manager who consistently protects capital in downturns is demonstrating that their process works under pressure. They're not just riding a wave, they're actually navigating the ocean. Seeing a fund fall only 15% when the market falls 30% tells you a far more powerful story about the manager's skill than seeing it go up 40% when the market is up 35%. Third, we must compare the fund to the right opponent. You wouldn't judge a heavyweight boxer's record by watching him fight featherweights. Similarly, you can't judge a mutual fund without looking at its proper benchmark. If a fund invests exclusively in large U.S. technology companies, its benchmark shouldn't be the broad S&P 500. It should be the tech-heavy NASDAQ 100. If it's a small-cap value fund, it needs to be measured against the Russell 2000 Value Index. Why? Because you need to isolate the manager's skill. If the entire tech sector soars 40% in a year, and a tech fund returns 42%, the manager's actual contribution, their alpha, was only 2%. The other 40% was just from being in the right place at the right time. But if that same tech sector returned 40% and the fund returned 55%, now you're seeing real skill. You're seeing a manager who isn't just riding the wave, but who has a powerful engine on their boat. Always ask, is this fund beating the market it's supposed to be beating? And has it done so consistently over 3, 5, and 10 years? This brings us to the final crucial piece of the puzzle, the manager's tenure. A fund's spectacular 10-year track record is utterly, completely 100% meaningless if the manager who generated it left last year. This is a trap countless investors fall into. They buy the fund's name, not realizing the brain behind the operation has changed. It's like buying a ticket to see your favorite band, only to find out all the original members have been replaced by a tribute act. The name on the ticket is the same, but the performance is not going to be. When you analyze a track record, you must align it with the current manager's start date. You are not investing in the history of the Fidelity Magellan Fund. You are investing in the skill of its current manager. If that manager has only been at the helm for 2 years, then you only have a 2-year track record to analyze. The decades of performance before that? It's irrelevant history. You are hiring a person, a pilot, to fly your money. You need to see their logbook, not the logbook of the pilot who flew the plane before them. So let's put it all together. The track record is the ultimate accountability mechanism. It's where the beautiful abstract ideas of philosophy and the disciplined, repeatable steps of process meet the cold, hard reality of the market. It's the proof. It's the evidence that the person in charge, the manager, can actually execute the plan. They can talk a great game about their brilliant philosophy, but the track record shows if they can actually play. It reveals their temperament under fire. It quantifies their skill against their peers. It tells you if they are a one-hit wonder who got lucky in a bull market, or a seasoned professional who can compound your capital through thick and thin. When you look at a fund's performance chart, don't just see a line. See a story. A story of decisions made, of crises weathered, of a philosophy tested. Read that story carefully, critically, and you'll discover that a great track record isn't about a single spectacular year. It's about a decade of resilience, a decade of consistency, a decade of proof that you're placing your trust and your future in the hands of a master craftsman. And once you've found a fund with a great philosophy, a great process, a great person at the helm, and the track record to prove it all, you might think you've found the perfect investment. But there is one more factor. A silent, insidious force that can take a winning fund and turn it into a losing proposition for you, the investor. A hidden drag that can devour tens, even hundreds of thousands of dollars from your returns over time without you even noticing. And understanding that force is the next critical step. That force is the single greatest predator of your investment returns. It's a silent, relentless parasite that attaches itself to your portfolio and feeds on it, day after day, year after year. It doesn't care if the market is up or down. It doesn't care about your retirement goals or your kid's college fund. It just eats. And the most insidious part is that it's designed to look so small, so insignificant, that most people ignore it completely. We're talking about fees. Specifically, the mutual fund's expense ratio. Now I know what you're thinking. Fees? Really? That's the big secret. It sounds boring, I get it. It's the least sexy topic in investing. But I promise you, by the end of this, you will see that the expense ratio isn't just a detail on a prospectus. It is the entire ballgame. It is the mathematical anchor that determines whether you will build extraordinary wealth or just spin your wheels for 30 years. An expense ratio is the annual fee that a fund charges to cover its operating costs. This includes the fund manager's salary, administrative staff, legal fees, accounting, and even marketing. It's expressed as a percentage of the total assets you have in the fund. So, if a fund has a 1% expense ratio, you are paying $1 for every $100 you have invested every single year. And this is where the great deception begins. Your brain sees 1% and thinks, that's nothing. I get a 10% return, they take 1%, I keep 9%. What's the big deal? That single, seemingly logical thought is one of the most expensive financial mistakes a person can make. Because that 1% isn't just 1% of your gains. It's 1% of your entire investment. Your principal, your past gains, everything. It's a wealth tax you pay every year for the privilege of someone else managing your money. Let me show you what this actually looks like. Imagine two friends, Sarah and Tom. Both are smart, they both decide to invest for their future. On the same day, they each invest $25,000 into a mutual fund. Let's say, through some stroke of luck, both of their fund managers are equally brilliant. Over the next 30 years, both funds they invested in generate the exact same excellent average gross return of 10% per year. The only difference is the fee. Sarah does her homework. She finds a great low-cost fund with an expense ratio of just 0.2%. This is a very reasonable fee, common for many index funds or low-cost actively managed funds. Tom, on the other hand, gets a recommendation from a broker. He's sold on a fund with a star manager, a glossy brochure, and what seems like a small fee, 1.2%. Just one single percentage point more than Sarah's fund. Sounds trivial. A rounding error. Let's see what that rounding error does over time. After 1 year, both funds earn 10%. Sarah's fund takes its 0.2% fee, so her net return is 9.8%. Her $25,000 grows to $27,450. Tom's fund takes its 1.2% fee, so his net return is 8.8%. His $25,000 grows to $27,200. The difference is just $250. Tom doesn't even notice. He's happy he made money. Now let's let the magic of compounding do its work. We'll jump ahead 10 years. Sarah's account, growing at 9.8% per year, is now worth over $63,000. Tom's account, growing at 8.8%, is worth about $58,000. The gap has widened to $5,000. It's starting to sting a little, but it's still not a life-changing amount of money. But the parasite of fees is patient, thrives on time. Let's jump to the 30-year mark, the finish line for their retirement savings. Sarah, with her low-cost fund, opens her statement. Her initial $25,000 has grown into an incredible $408,000. A testament to the power of the market and long-term investing. Now it's Tom's turn. He opens his statement. Remember, his fund manager was just as good. His fund picked the same great stocks and achieved the same 10% gross return every year. But that tiny, insignificant 1% difference in fees has been working against him year after year. His final balance is not $408,000. It's not even $350,000. Tom's final balance is $283,000. Let that sink in. $125,000. Gone. Evaporated into the pockets of the fund company. That's not just a number. That's a brand new car and a decade of dream vacations. That's the difference between a comfortable retirement and a retirement filled with financial anxiety. It's a fortune lost to a single percentage point that looked harmless 30 years earlier. And here's the truly brutal part. That high-fee fund manager didn't just have to be good. To justify his 1.2% fee, he had to be a miracle worker. He had to consistently outperform Sarah's low-cost fund manager by a full percentage point every single year, just for Tom to end up with the same amount of money. The hurdle is immense. The data overwhelmingly shows that almost no one can do it consistently over the long run. The higher the fee, the higher the hurdle, and the lower your probability of success becomes. But the expense ratio is just the main villain. It often brings its friends along. You have loads, which are basically sales commissions. A front-end load of 5% means if you invest $10,000, they immediately take $500 off the top. Your investment starts day one with a 5% loss you have to climb out of. A back-end load charges you a fee to sell your shares. Then you have the truly sneaky ones like 12b1 fees. These are fees buried inside the expense ratio that the fund uses for marketing and advertising. Let me rephrase that. You are literally paying the fund company to run commercials and print brochures to convince other people to invest. It's like paying a restaurant for the billboard they put up on the highway. It does nothing to improve your meal, and it does nothing to improve your returns. And there's another hidden cost, one that doesn't even show up in the expense ratio: turnover. A fund's turnover rate tells you how often the manager is buying and selling stocks. A 100% turnover means the manager has, on average, replaced every stock in the portfolio within a year. All that trading racks up brokerage commissions and other transaction costs that are passed on to you, the investor, and directly reduce your returns on top of the expense ratio. It's a hidden fee on top of the stated fee. A high turnover, high expense fund is like trying to fill a bucket with water while two people are drilling holes in the bottom. So when you're hunting for a high return mutual fund, the very first filter, the first question you must ask, is not, who is the manager? Or, what was its return last year? The first question is, what is the price of admission? Because if the price is too high, you've lost the game before it even starts. The single greatest predictor of a fund's future performance, proven by study after study from independent sources like Morningstar, is not past returns. It is cost. Low-cost funds as a group consistently outperform high-cost funds over the long term. You cannot control what the stock market will do next year. You cannot control whether a CEO will make a brilliant or a disastrous decision. You cannot control geopolitical events or interest rates. But you can absolutely 100% control the fees you are willing to pay. And choosing to minimize that cost is the most powerful and reliable move you can make to maximize your wealth. So we've unmasked this silent killer of wealth. We understand that fighting fees is the first, non-negotiable battle. But this raises an even bigger question. If most high-fee funds are a losing game, where do the true high-return giants actually come from? Are they all just low-cost index funds? Or are there actively managed funds that are worth it? Are they a myth? Or are they hiding in plain sight, using a core philosophy that has almost nothing to do with what Wall Street typically sells you? The answer lies not just in what they buy, but in how they are built from the ground up. Let's start by demolishing a common myth. The myth is that successful investing is all about complex algorithms, lightning-fast trading, and having access to some secret, privileged information. The reality, for the funds that consistently deliver staggering returns over decades, is far more human. It's about a philosophy, a mindset, a particular way of looking at the world that is fundamentally at odds with the frantic short-term noise of the market. The first, and arguably most important, factor behind a high-return mutual fund is the person in the driver's seat. The fund manager. We're not talking about a faceless committee or a black box computer program. We're talking about a human being or a small cohesive team with a distinct and powerful investment philosophy. The value they add is a concept known as managerial alpha. Alpha is just the fancy Wall Street term for returns above and beyond the market benchmark. If the S&P 500 returns 10% and your fund returns 15%, that extra 5% is your alpha. And for the elite funds, that alpha doesn't come from luck. It comes from the manager's skill, discipline, and courage. Think of it like this. 2 world-class chefs are given the exact same ingredients, the same prime cuts of meat, the same farm-fresh vegetables, the same exotic spices. One chef follows a standard recipe, cooks everything perfectly, and produces a very, very good meal. The other chef, however, has a unique vision. They combine flavors in an unexpected way, use a technique no one else has mastered, and present the dish with an artist's flair. They create something not just good, but truly unforgettable. The ingredients were the same, but the philosophy and execution were different. In the world of investing, the stocks are the ingredients, the manager is the chef, and managerial alpha is the Michelin star. So what does this master chef, this elite fund manager, actually look like? What are the core traits that define them? The first is a deeply ingrained contrarian mindset. This is one of the most misunderstood concepts in investing. Being a contrarian doesn't just mean buying stocks that have gone down, or betting against popular trends for the sake of it. That's just being stubborn. A true contrarian has a well-researched, independent thesis about the value of a business that differs from the prevailing market consensus. They do their own homework, build their own models, and have the intellectual honesty to say, the entire market is wrong about this, and here are the 10 reasons why. Imagine the pressure in late 2016. The consensus was that traditional brick-and-mortar retail was dead. Amazon was the unstoppable juggernaut, the Death Star, and any company with a physical store was on a path to bankruptcy. Stocks of retailers were being thrown out like garbage. The herd was selling, panicking at every negative headline. The contrarian manager, however, was doing something different. They weren't reading the headlines, they were reading the balance sheets. They were visiting the stores. They were analyzing the value of the real estate these companies owned. And they might have concluded that a specific company, say a home improvement giant or a discount retailer, had a loyal customer base, a defensible moat, and was trading for a fraction of its true worth. So while everyone else sold, they bought. They looked like fools for a while. But over the next few years, as these strong retailers adapted and thrived, their thesis was proven right, and their investors were rewarded handsomely. That willingness to stand alone, armed with research and reason, is the bedrock of long-term outperformance. This contrarian nature leads directly to the second trait, high conviction, which manifests in a concentrated portfolio. If you've spent hundreds of hours researching a company and have developed a powerful, independent thesis that is dramatically undervalued, does it make sense to make it a tiny 0.5% position in your portfolio? Of course not. You bet big. The greatest investors of all time, from Warren Buffett to Peter Lynch, have always advocated for concentration. This is the polar opposite of how most of the mutual fund industry operates. The average U.S. equity fund holds over 200 stocks. Many hold over 1,000. This isn't an investment strategy. It's a career preservation strategy. It's called hugging the index. If a manager owns a little bit of everything, they can never be spectacularly wrong. They'll never have a year where they're down 30%, while the market is up 10%. But by diversifying away the risk of being wrong, they also diversify away any chance of being spectacularly right. They are mathematically guaranteeing mediocrity. The elite manager rejects this. Their portfolio might only contain 20 to 40 stocks. They know each company like the back of their hand. Their top 10 holdings might make up 50% or even more of the entire fund. Every single position has to fight for its place. This is an active, deliberate choice. They are saying, these are my absolute best ideas. I have done the work, I have the conviction, and this is where I am placing my capital and my reputation. This level of concentration is terrifying to the average investor and the Wall Street establishment, but it is the only way to generate truly exceptional returns. You cannot outperform the herd if you are invested in the herd. The third trait is the glue that holds the first two together: an exceptionally long-term time horizon. You simply cannot be a contrarian or run a concentrated portfolio if you are obsessed with the next 3 months. The entire financial media and Wall Street apparatus is a machine built to generate short-term noise. Quarterly earnings reports, analyst upgrades and downgrades, daily price wiggles. It's all a distraction from what truly matters, which is the long-term intrinsic value of a business. The best managers are playing a different game entirely. They think in increments of 5, 10, even 20 years. They aren't renting stocks. They are buying pieces of businesses. They understand that a truly great company, a dominant brand, a technological marvel, a low-cost producer, will inevitably face headwinds. There will be recessions, new competitors, bad quarters, and moments of public panic. For the short-term trader, these are signals to sell. For the long-term business owner, these are incredible opportunities to buy more of a wonderful company at a discounted price. This long-term view provides the psychological fortitude required to be a contrarian. When your concentrated bet is down 20% and the news is screaming that you're wrong, it's not a spreadsheet that keeps you holding on. It's the deep, multi-year conviction in the underlying business. It's the ability to turn off the noise and focus on the fundamentals. They are not planting tulips to be flipped in a month. They are planting oak trees that will compound wealth for a generation. So, how can you, as an investor, get a glimpse into the mind of a manager to see if they possess these traits? One of the most powerful and criminally underutilized tools is the manager's annual or semi-annual letter to shareholders. Most of these are filled with dry corporate jargon, but the letters from the greats are different. They are a masterclass in clear thinking. They will explain their philosophy, walk you through their biggest holdings, and most importantly, they will discuss their mistakes with candor and humility. They don't blame the market or the economy. They take ownership. Reading these letters is like having a direct conversation with the person managing your money. You can feel their passion, their discipline, and their long-term focus. It is the single best way to separate the true master chefs from the short-order cooks. These 3 pillars, a contrarian mindset, a high-conviction concentrated approach, and a long-term time horizon, form the philosophical core of almost every legendary mutual fund. It's a potent combination, but it also creates a very specific kind of investment vehicle, one that is destined to be volatile, to look wrong for long stretches of time, and to test the patience of its investors. The manager's mind is the engine of outperformance. But even the most powerful engine is useless if it's placed in a flawed vehicle. What if the very structure of the fund itself, its size, its fees, its rules, is silently working against you? A brilliant manager can be handicapped by a bloated fund, just as a world-class pilot can't win a race in a station wagon. And it is this vehicle, the structure of the fund itself, that often separates the legends from the long list of those who tried and failed. So let's talk about the machine itself. Because the greatest manager in the world, with the sharpest instincts and the most brilliant analysis, is ultimately driving a vehicle designed by someone else. That vehicle is the mutual fund, and its design, its very blueprint, is laid out in a document that almost nobody reads. It's called the prospectus, and buried within its dense legal language are the rules of the race, the very factors that can predetermine a fund's success or failure. Think of it this way. A fund's mandate, its core objective stated in the prospectus, is like telling a race car driver what kind of race they're in. Is it the Indianapolis 500 requiring pure speed and precision on a paved oval? Or is it the Baja 1000, a brutal off-road endurance test? The car you build for each is wildly different. The same is true for mutual funds. A fund might have a mandate to only invest in large-cap American utility companies. That's a very specific, very rigid race. The manager of that fund could discover the next Amazon, a tiny, explosive growth company, but be legally forbidden from buying it. Their hands are tied by the mandate. They're driving a car built for stability, not for explosive speed. On the other hand, you have funds with what's called a go-anywhere mandate. These are the funds that tell their manager, your job is to win. We don't care if you do it with stocks from Brazil, bonds from Germany, or small-cap tech from Silicon Valley. Find the best opportunities on the planet and go get them. This gives a skilled manager incredible flexibility. It allows them to pivot, to be opportunistic, and to hunt for value wherever it might be hiding. It's like giving your world-class driver a vehicle that can morph and adapt to any terrain. But this freedom is a double-edged sword. In the hands of a less skilled manager, a go-anywhere mandate can lead to disaster, chasing fads and taking on unmanaged risks. The key is that the mandate defines the universe of possibilities. A restrictive mandate can protect against foolishness, but it can also be an anchor that prevents greatness. A flexible mandate can unlock genius, but it can also unleash chaos. Understanding this single rule, what race is the fund actually in, is the first step to separating the contenders from the pretenders. Now let's assume we have the right car for the right race. The next thing we have to look at is the built-in drag. Every race car has it. It's the forces of friction and air resistance that are constantly trying to slow it down. In the world of mutual funds, this drag has a very specific name: the expense ratio. The expense ratio is, simply put, the cost of running the fund. It pays for the manager's salary, the research analyst, the marketing team, the office rent, the legal fees, everything. And it's expressed as a percentage of the fund's assets, deducted from your investment, year after year after year, like clockwork. Whether the fund makes you 30% or loses you 30%, the expense ratio gets paid. It is a constant, relentless headwind. And you might look at a number like 1% or 1.5% and think, what's the big deal? Sounds trivial. But compounding is a force of nature, and it works both ways. Let's run a quick and frankly terrifying experiment. Imagine you invest $10,000. Let's say the market gives you a nice steady 8% average annual return over 20 years. Now, you put that money in Fund A, which has a low expense ratio of 0.5%. Your net return is 7.5%. After 20 years, your $10,000 grows to about $42,500. Not bad. But your friend invests their $10,000 in Fund B. It has a hotshot manager and a great story, but it also has a higher expense ratio of 1.5%. Their net return is 6.5%. After 20 years, their $10,000 grows to just over $35,000. Let that sink in. A 1% difference in the annual drag didn't just cost them 1%. Over 20 years, it cost them $7,500 in pure profit. That's 75% of their initial investment gone, vanished into thin air, eaten by fees. The high-fee fund had to be dramatically better, year after year, just to break even with the low-fee fund. The expense ratio is the single most reliable predictor of future fund performance. Not the manager's face on a magazine cover. Not the 5-star rating from last year. This tiny boring number. Because it's the one thing we know for sure in an uncertain future. It's the handicap the fund carries in every single race. The lower the drag, the faster the car can go. Finally, let's talk about the pit stops. In racing, you can have the fastest car and the best driver, but if your pit strategy is a mess, if you're constantly in the pit changing tires, making adjustments, you're going to lose. Every second you spend in the pit is a second you're not on the track making progress. In mutual funds, the pit stops are called turnover. Turnover is a measure of how frequently the fund manager buys and sells the stocks in the portfolio. A fund with 100% turnover has, in effect, replaced its entire portfolio within a single year. A fund with 20% turnover is much more patient, holding on to its investments for an average of 5 years. Now, why does this matter? Because every single trade has costs. First, there are the obvious costs, brokerage commissions. Just like you pay a fee to trade stocks, so do giant mutual funds, and those costs are passed on to you, the investor. But the bigger, more insidious costs are hidden. There's something called the bid-ask spread, which is a tiny price difference that acts as a hidden tax on every transaction. When you're trading billions of dollars, those tiny taxes add up to a mountain of money. But the real killer, the one that directly impacts your personal bottom line, is taxes. When a fund manager sells a stock for a profit, they create a capital gain. At the end of the year, the fund is legally required to distribute those gains to its shareholders. And guess who has to pay the taxes on those gains? You do. This is a point that shocks most investors when they first understand it. You can have a year where your fund's value actually went down, but because the manager was doing a lot of buying and selling inside the fund, you could still receive a capital gains distribution and a surprise tax bill in April. High turnover is like a leaky engine, constantly dripping away your potential returns in the form of trading costs and tax inefficiency. A low turnover rate, on the other hand, often signifies a manager with a completely different philosophy. It suggests patience, conviction. It implies they aren't just renting stocks, they are buying businesses. They've done their homework and are willing to hold on for the long term. letting their ideas play out. This is the mindset of an investor, not a trader. It's more tax efficient, it's lower cost, and it shows a belief that true value is built over years, not days or weeks. So when you look at the structure of a fund, you're looking at its very soul. The mandate tells you the game it's playing. The expense ratio tells you the headwind it's fighting against. And the turnover rate tells you the philosophy of the person behind the wheel. A great fund is a masterpiece of design. A flexible mandate in the hands of a smart manager, an ultra-low expense ratio that keeps drag to a minimum, and a patient, low-turnover approach that minimizes friction costs and taxes. Get these structural elements right, and you've engineered a vehicle that's actually built to win. But there's one more structural element, one that's almost invisible to the average investor, but it has the power to either supercharge a fund's returns or cripple it from the inside out. It's not about costs or rules, it's about culture. And it's the secret ingredient that separates the good from the truly legendary. Think of the greatest sports dynasties in history. The '90s Chicago Bulls, the New England Patriots under Brady and Belichick, the Golden State Warriors. What did they all have in common? It wasn't just having the best players. It was a winning culture. An invisible force that dictated how they practiced, how they prepared, how they trusted each other under pressure. It was an expectation of excellence that permeated the entire organization, from the star player down to the equipment manager. A high-return mutual fund is no different. The culture of the firm managing your money is the single most important, yet least discussed, factor in its long-term success. It's the firm's operating system. It dictates how they think, how they behave, and most importantly, how they make decisions with your capital when the market is in a full-blown panic. So what does a winning investment culture actually look like? It's built on 4 fundamental pillars. The first pillar is a fanatical obsession with the long term. This sounds simple, but in the world of Wall Street, it's revolutionary. The entire financial media ecosystem is built on short-term noise. What did the Fed say today? What are the quarterly earnings for this company? Is the market up or down this week? It's a constant barrage of information designed to make you act, to trade, to do something. Firms with a winning culture build a fortress against this noise. They think in terms of years and decades, not days and quarters. They view themselves not as traders of stock tickers, but as part owners of actual businesses. They ask questions like, will this company be more dominant and more profitable 10 years from now? Does it have a durable competitive advantage, a moat, that will protect it from competition for a generation? They operate like a patient farmer, not a frantic day trader. A farmer plants an oak tree sapling. For the first few years, not much happens. It requires water, sunlight, and protection. A casual observer might walk by and say, that's a waste of good soil. You could have planted fast-growing weeds and had something to show for it in a month. But the farmer knows that in 30 years, he won't have a patch of weeds. He'll have a mighty oak tree providing shade and value for a lifetime. That is the mindset. They buy wonderful businesses and are perfectly happy to do nothing for a very, very long time. This patience is their superpower. It allows them to ignore the market's manic mood swings and hold on to their winners, letting them compound wealth year after year. It also gives them the courage to buy when everyone else is selling, because they're focused on the 10-year value of the business, not the 10-day price of the stock. The second pillar is profound intellectual honesty. Investing is a humbling business. Even the best in the world are wrong a lot. The difference is, a winning culture embraces its mistakes. They study them. They learn from them. Ego is the enemy of great returns. In a weak culture, when a stock pick goes wrong, you hear excuses. The market was irrational. The Fed changed its policy. It was an unforeseeable event. It's always an external factor to blame. In a winning culture, the first question they ask is, what did we miss? Where was the flaw in our analysis? What was the mistaken assumption we made? They perform postmortems on their losing investments with the same rigor a surgeon would review a failed operation. Not to assign blame, but to extract a lesson. This creates a feedback loop of continuous improvement. Every mistake, every loss, makes the team smarter and their investment process more robust for the future. This culture of intellectual honesty also means they welcome dissent. The best investment firms are not echo chambers where everyone agrees with the boss. They are arenas of ideas where analysts are encouraged, even required, to challenge each other's assumptions, to play devil's advocate, to try and kill a new stock idea. They know that a thesis that can withstand intense internal scrutiny is far more likely to withstand the chaos of the real world. They would rather have a fierce debate in the conference room than a catastrophic loss in the portfolio. The third pillar is a structure that values the team over the star. We've all seen the star manager phenomenon. A fund manager has a few great years, gets plastered on the cover of magazines, and becomes a celebrity. The fund company markets the heck out of this one individual. But this model is incredibly fragile. What happens if that star manager retires, gets poached by a competitor, or simply loses their touch? Often, the entire strategy collapses, and the investors who piled in at the peak of the hype are left holding the bag. A truly durable culture is built around a team and a process. It relies on a deep bench of talented analysts and portfolio managers who share a common investment philosophy. The process for researching companies, valuing them, and constructing the portfolio is repeatable and transferable. The goal isn't to have one genius making all the calls. It's to have a system of excellence that outlasts any single individual. A great way to think about this is the bus test. If the lead portfolio manager were to get hit by a bus tomorrow, would the fund's performance fall off a cliff? In a star-driven system, the answer is almost certainly yes. In a team-based, process-driven culture, the answer is no. The philosophy is so deeply embedded, and the team is so capable that they can continue executing the strategy seamlessly. This provides a massive layer of security and consistency for you, the long-term investor. And that brings us to the fourth and perhaps most powerful pillar: skin in the game. This is the ultimate alignment of interests. In simple terms, it means the people managing the fund have their own money, a significant amount of their own personal net worth, invested right alongside yours in the very same fund. Think about it. Would you trust a chef who refuses to eat his own cooking? Would you trust a home builder who wouldn't live in a house he built? Of course not. So why would you entrust your life savings to a fund manager who isn't willing to invest their own family's capital in their own strategy? When a manager has skin in the game, it's not just a job anymore. It's personal. Your wins are their wins. More importantly, your losses are their losses. They feel the pain of a down market in their own bank account, not just in an abstract performance report. This changes everything. It ensures they are not taking reckless, speculative bets with your money to chase a short-term bonus. It forces them to think like true owners, protecting capital on the downside just as fiercely as they pursue growth on the upside. It is the single clearest signal that they genuinely believe in their own process and are committed to the long-term outcome. So how can you, the average investor, possibly assess something as squishy as culture? You read, you listen, you look for the clues. Go to the fund company's website and read their shareholder letters going back several years. Do they talk obsessively about the long-term prospects of the businesses they own? Or do they spend all their time explaining the zigs and zags of the stock market and the economy? Do they openly and honestly discuss their mistakes, what they learned, and how they've improved? Or do they gloss over poor performance and blame it on the Fed? When you watch interviews with the portfolio managers, do they talk in terms of we, and our team, and our process? Or is it all I think and my big call? And finally, dig into the fund's documents, like the statement of additional information, or look on data providers like Morningstar to find out about manager ownership. Is it a token amount, or are they truly eating their own cooking? These four pillars, a long-term obsession, intellectual honesty, a team-first approach, and significant skin in the game, are the invisible architecture that supports enduring investment success. They don't show up in a stock chart or a performance table, but they are the foundational elements that allow a fund to navigate the inevitable storms of the market and compound your capital over a lifetime. Finding a firm with this culture is like finding a partner for a long and prosperous journey. But even with the right people and the right mindset, you still need a map. You need a clear, repeatable process for actually finding the world's greatest businesses. And that exact process, that's the engine we're going to break down next. So what does this engine, this repeatable process, actually look like? It's not a black box or some mystical algorithm. It's a disciplined four-part framework, a series of filters that every potential investment must pass through. Think of it as a gauntlet. Most companies fail at the first hurdle. Only the truly exceptional make it all the way through. The first filter, the very foundation of this entire philosophy, is business quality. The central question is brutally simple. Is this a truly wonderful business? We're not talking about a company that's popular this quarter or has a hot new product. We're talking about a business with a durable, long-term competitive advantage, an economic fortress. Warren Buffett famously calls this a moat. A moat is a structural advantage that protects a company from competition, Just like a real moat protects a castle from invaders. These moats come in different forms. Could be an intangible asset like the brand power of Coca-Cola. For over a century, competitors have tried to replicate it, but that red and white logo is seared into the global consciousness. It could be a network effect like with Meta or Google. The more people who use Facebook, the more valuable it becomes for the next person to join. The more people who search on Google, the better its search results get, which attracts more users. It's a virtuous cycle that competitors find almost impossible to break. It could be high switching costs. Think about the software that runs your entire business. The cost, the time, the sheer headache of switching to a new system is so immense that you'll stick with your current provider, even if a slightly cheaper alternative comes along. These are the kinds of businesses we're looking for. Companies that aren't just winning today, but have a structural reason why they will likely keep winning for the next 10, 20, or even 30 years. They have pricing power, the ability to raise prices without losing customers, which is the ultimate sign of a great business and a crucial defense against inflation. They generate torrents of cash and, most importantly, they earn high returns on the capital they invest back into their own operations. We're hunting for the oak trees, not the weeds that shoot up overnight and die just as fast. But even the greatest castle is vulnerable if the person in charge leaves the gates wide open. This brings us to the second filter, management quality. A great business can be destroyed by a mediocre manager, and a good business can be elevated to greatness by an exceptional one. So, how do you judge the people at the helm? It's not about charisma or a flashy presentation on TV. It's about two things: integrity and capital allocation. Integrity is the bedrock. Are the leaders honest with their shareholders? Do they communicate clearly in their annual reports, admitting mistakes as openly as they celebrate successes? Do they have a history of treating all stakeholders, employees, customers, and owners fairly? We're looking for CEOs who think and act like long-term owners, not like hired hands trying to maximize their next bonus. We want to see that they have significant skin in the game, with their own wealth tied up in the same stock as their investors. But integrity alone isn't enough. The most critical skill of a CEO is capital allocation. A successful company generates a lot of cash. The CEO's job is to decide what to do with that cash. Do they reinvest it back into the business to fuel more growth? Do they buy back their own stock? Do they acquire other companies? Or do they pay it out as a dividend? There is no single right answer, but the decisions they make will determine the company's fate. A brilliant capital allocator will reinvest profits into projects that earn very high rates of return, creating a compounding machine that snowballs shareholder wealth over time. A poor capital allocator will squander that cash on ego-driven, overpriced acquisitions that destroy value. We study their track record relentlessly. We want to partner with managers who are not just great operators, but master investors in their own right. So we have a wonderful business run by brilliant, honest managers. What's next? The third filter is financial strength. Even the strongest castle with the wisest king can't survive if it's built on a foundation of sand. We are looking for fortress balance sheets. This means low levels of debt or ideally no debt at all. Debt is like a double-edged sword. It can amplify returns in the good times, but it can be a death sentence in the bad times. When a recession hits and revenue dries up, companies with huge interest payments can go bankrupt. Companies with clean balance sheets, on the other hand, can not only survive but can go on the offensive, buying up struggling competitors or investing for the future while everyone else is panicking. We want to see a long history of consistent, growing free cash flow. Profit is an opinion, but cash is a fact. We want businesses that gush cash, proving their economic model is not just sound but powerful. This financial prudence ensures resilience. It means the company is not beholden to the whims of the capital markets or the mood of its bankers. It is the master of its own destiny. This isn't the most glamorous part of the analysis, but it's absolutely non-negotiable. We are looking for survivors, companies built to withstand any economic storm. Now for the final crucial hurdle. A company can pass the first three tests with flying colors: a wonderful business, great management, a rock-solid balance sheet, and still be a terrible investment. Why? Because of its price. This brings us to the fourth and final filter: valuation. The best funds understand a fundamental truth. What you pay determines your return. Finding a great company is only half the battle. You have to buy it at a sensible price. This doesn't necessarily mean cheap in the traditional sense. A truly exceptional business is rarely found in the bargain bin. But it does mean paying a price that provides a margin of safety. This is the cornerstone of intelligent investing. It means you estimate what a business is truly worth, its intrinsic value, and you insist on buying it at a significant discount to that value. That discount, that gap between price and value, is your protection against the uncertainties of the future. It protects you if you've made a mistake in your analysis. It protects you if the company hits an unexpected rough patch. And it's the source of your future returns. Buying $1's worth of a fantastic business for 60 or 70 cents is how you generate extraordinary long-term results. This discipline prevents you from getting caught up in hype and euphoria. When a stock is soaring and everyone is clamoring to get in, a disciplined investor steps back and asks, is the price I have to pay today justified by the future cash flows this business will generate? More often than not, during periods of mania, the answer is no. They are willing to be patient, sometimes for years, waiting for the perfect pitch, that rare moment when one of the world's best companies is offered at a fair, or even a bargain price. So there it is. The 4 pillars. A wonderful business with a durable competitive moat, run by honest and brilliant capital allocators, supported by a fortress balance sheet, and purchased at a sensible price that provides a margin of safety. This isn't a get-rich-quick scheme. It's a methodical, disciplined process for identifying the handful of elite businesses that are capable of compounding wealth for decades. It's the map, but having the map and actually completing the treacherous journey are two very different things. Because the single biggest obstacle to long-term success isn't finding the right companies. It's the 6 inches between your ears. That's right. The most brilliant fund manager on the planet, armed with a time-tested, world-beating strategy, can hand you a golden ticket to wealth creation. And it can all be rendered completely worthless by the emotional, irrational, and deeply human impulses that fire off inside your own brain. This isn't a theory. It's a measurable phenomenon. It's called the behavior gap. Morningstar, the financial research firm, has studied this for years. They compare 2 numbers. Number 1 is the total return of a mutual fund. This is the number you see in the brochure. The 20% gain it posted last year. Number 2 is the investor return. This is the actual real-world return that the average person who invested in that fund actually received. And almost without fail, the investor return is lower. Often significantly lower. How is this possible? How can a fund return 20% but the average investor in it only makes, say, 12%? It's because investors are not robots. They don't just buy a fund and hold it. They react. They get scared. They get greedy. They buy high and sell low. The fund itself might be a finely tuned Ferrari, capable of incredible performance. But the average investor is driving it like a student driver in a panic, slamming on the gas when the road is clear and everyone is cheering, and then slamming on the brakes and pulling over the second it starts to rain. The car is capable of greatness, but the driver's timing is terrible. That difference between the car's potential and the driver's actual result? That's the behavior gap. And it is the single biggest destroyer of wealth for most people. This gap is created by the 2 most powerful emotions in finance: fear and greed. Let's start with greed. You see a fund at the top of the charts. It's up 50% in the last 12 months. The headlines are glowing. Your friend at a barbecue is bragging about how much money they made on it. The fear of missing out, or FOMO, kicks in. It's a powerful primal urge. So you pile in. You and thousands of other people chasing that hot performance. But here's the problem. You're buying after the incredible run-up. You're showing up to the party just as the lights are about to come on. Asset classes and strategies revert to the mean. The very conditions that led to that 50% gain are unlikely to repeat themselves immediately. More often than not, that high-flying fund will cool off or even drop right after all the new money floods in. Greed made you buy at the point of maximum excitement, which is often the point of maximum risk. But as destructive as greed is, its dark twin, fear, is infinitely more powerful. Fear is what turns a temporary market downturn into a permanent personal loss. Let me paint a picture. It's 2008, or March of 2020. The market has been falling hard. Every day you open your account, the number is smaller. Red. Minus 10%. Minus 20. The news is a nightmare. Pundits on TV are screaming about a global meltdown. A new Great Depression. Your gut is churning. That money wasn't just a number on a screen. It was your retirement, your kid's college fund, your financial security. And it is evaporating. Every instinct in your body, every self-preservation circuit honed over millions of years of evolution, is screaming at you. Get out. Sell. Stop the bleeding. Just make it stop. And so, many people do. They sell. They capitulate. They sell their stake in some of the world's greatest companies at a 30 or 40% discount from where they were just a few months earlier. They think they're being safe. What they're actually doing is taking a temporary on-paper loss and making it a permanent, catastrophic real-world loss. They lock it in. And in doing so, they violate the single most important rule of building wealth. Buy low, sell high. They do the exact opposite at the worst possible moment. Imagine two investors. Let's call them Steady Sarah and Panic Paul. On the exact same day, they both invest $10,000 into the exact same high-return mutual fund we've been talking about. For 2 years, the market does well. Their investment grows to $15,000. Paul is ecstatic. He checks his account daily, feeling like a genius. Sarah has her contributions on autopilot and rarely even looks. Then the storm hits. The market crashes. In 6 months, their $15,000 is back down to $10,000, and then it keeps falling all the way to $8,000. Paul is in full-blown panic mode. The news is terrifying. He can't take it anymore. He sells everything at $8,000, telling himself, "I just have to get out. I'll get back in when things are more certain." He has officially lost $2,000. Sarah feels the fear too. She's human, but she understands the fund's philosophy. She trusts the long-term process. She remembers that volatility is the price of admission for higher returns. Not only does she not sell, but her automatic monthly contribution continues. Except now, her $200 a month isn't buying shares at peak prices. It's buying them at a massive discount. She is, without even thinking about it, buying low. A year goes by. The panic subsides. The economy begins to recover. The market roars back to life. The fund's value soars past its old highs. Sarah's account, which she held through the dip and to which she kept adding, is now worth $22,000. What about Paul? He saw the market was recovering, but he waited for certainty. He finally felt safe enough to get back in, but by then, the fund was already back near its old highs. He bought back in and essentially started over, having locked in his $2,000 loss and missed the entire explosive recovery from the bottom. Same fund, same timeline, wildly different outcomes. The variable wasn't the expense ratio, the manager, or the strategy. It was the investor. So how do you become Sarah, not Paul? It comes down to two things: temperament and time horizon. Warren Buffett famously said, "The most important quality for an investor is temperament, not intellect." You don't need to be a genius to succeed. You need to be able to control your emotions. You need the discipline to stick to your plan when every fiber of your being wants to abandon it. This is why understanding a fund's philosophy, which we talked about in earlier parts, is so critical. It's not just an academic exercise. Believing in why you own what you own is the bedrock of conviction that allows you to hold on during the storm. If you don't understand the strategy, you'll abandon it at the first sign of trouble. And the ultimate weapon against fear is a long time horizon. If you need your money next year, you shouldn't be in a stock mutual fund. But if your goal is 10, 20, or 30 years away, then a 20% drop this year is just a blip. It's noise. It's a sale. Viewing market downturns as temporary discounts instead of permanent threats is a fundamental shift in mindset that separates successful investors from everyone else. This is where a simple strategy like dollar-cost averaging, investing a fixed amount of money at regular intervals, becomes so powerful. It's not just a financial strategy, it's a behavioral one. It automates good decisions. It forces you to buy more shares when prices are low and fewer shares when prices are high. It takes your panicky, emotional fingers off the buy and sell buttons and puts the process on a logical, unemotional autopilot. It's a system designed to protect you from yourself. So, as we end this journey, what is the ultimate factor behind high-return mutual funds? We've looked at fees, managers, strategies, and stock selection. All of them are critically important pieces of the puzzle. They are the map to buried treasure. But the final, most important factor is you. Your ability to execute the plan. Your ability to master the 6 inches between your ears. The best fund in the world is useless if you sell it at the bottom. A slightly above average fund that you can understand, believe in, and hold for decades will make you fantastically wealthy. The goal isn't to find an investment that never goes down. That doesn't exist. The goal is to find a brilliant investment and then develop the personal fortitude to stick with it through the inevitable and terrifying downturns. The greatest returns don't go to the smartest investors. They don't go to the luckiest investors. They go to the most patient investors. The secret to winning the game isn't outsmarting everyone else. simply staying in the game.